Okay, it's 1 o'clock, so we're going to get underway. Thank you to everyone who has joined us for this afternoon's live webinar. We're going to be presenting to you on estate planning for you and future generations, a holistic approach. My name's Scott Garner. I work at Rix & Kay. I head up the firm's business development function. Just a little bit of housekeeping before we get underway today. So the session is being recorded. So if you do want to watch it after the live event, for any reason, it will be available to you. We'll make sure that comes round. We're going to do a question and answer session. So if you have questions as we go through the presentations this afternoon, please use the Q&A function at the bottom of the Zoom screen. Post your questions and we'll pick those up at the end. If we do have an abundance of questions, we may not have time to get through all of them during the live session, but we will come back to you one way or another. The speakers will, I'm sure, pick up with you. So if we don't get to your question, then we will come back to you regardless, as I said. Just a little bit about the organisations that are presenting this afternoon. So Rix & Kay is a full-service law firm. We have offices across Sussex and Kent. We have an extensive corporate offering, providing the full range of legal services to businesses. And we also have an extensive private client offering where we advise the owners of those businesses and the directors of those businesses. We're also joined by Carpenter. Carpenter are a established chartered accountants with offices throughout Sussex. They're also tax and business advisors. The speakers there on your screen, I'm sure they'll do their own introductions, but very briefly, my colleagues Catherine Paisley and Bruce Clark. Catherine heads up the corporate department at Rix & Kay, and Bruce heads up the private client department. And also David Krauser from Carpenter, who's a tax partner. So I think that's enough from me. I will see you again at the end for the Q&A session. Without further ado, I'm going to hand over to my colleague Bruce Clark, who's going to take you through the first part of the session.
Thank you very much, Scott. Good afternoon, everybody. Thank you for joining us for today's webinar. For those who don't know me, my name is Bruce Clark. I lead the private client team here at Rix & Kay. A bit of housekeeping of my own. Those who have been on calls with me before on Zoom will know that I have a cat that likes to make herself very well known at the most inappropriate times, and I've done my best to try and get rid of her, but unfortunately she's true to form here, so she does appear. My apologies there, but hopefully she won't cause too many problems. Today's webinar, we're going to be looking at estate planning and why it's important to adopt that holistic approach. When doing so, although we'll be covering some of the opportunities available in terms of gifts, trusts and family investments and family investment companies and LLPs, we'll be doing it on a technical level, but we'll also be taking a bit more of a practical look at things as well. And hopefully by the end of the webinar, we'll have given you a bit of a better understanding of why it's important for anyone undertaking estate planning exercises to ensure that everybody's on board working together, whatever their role or specialism. As always with webinars, this is going to be a bit of a whistle-stop tour of the various topics, but as I say, hopefully by the end we'll have been able to demonstrate clearly why it's important that we do take that holistic approach. And so moving on to the next slide, I suppose the first question we'd better start with is, what is estate planning? Estate planning is a term that can be used to cover a number of fields, really. For example, tax planning or succession planning. But the key thing is, it isn't possible to look at one of those areas in isolation, and the impact that undertaking an exercise in that specific area, for example, a tax planning exercise, needs to be considered and has what it has on the other areas. So in essence, really, estate planning is a term that encompasses whatever planning is necessary for one's estate to achieve that end goal, whatever that end goal may be. And so, as we say, will encompass many, many aspects. And to begin with, I'm going to briefly look at the interaction of wills and lasting powers of attorney in estate planning, and then later on how trusts feature in the estate planning piece. I won't be touching on the tax elements of that. I'll be leaving that to David. But rather some more practical elements, the wider elements that we need to consider. And so let's begin on the next slide with having a look at what the difference is between a will and a lasting power of attorney. I'm going to call them LPAs throughout this, just to shorten them a bit, make things a bit quicker. But we'll have a look at then the differences and how they fit in with the overall estate planning exercise. As I'm sure many of you are aware, essentially a will deals with the estate planning element after death. The will stipulates how an estate devolves to chosen beneficiaries, and it's the choosing of those beneficiaries and why the person has chosen them that's the estate planning exercise. But the key thing is with the will is it's a post-death estate planning exercise. It's got to dovetail with any lifetime estate planning. And whilst the will deals with the devolution of estate post-death, LPAs deal with allowing someone to make decisions in the event of loss of capacity. And it's an important part of the lifetime estate planning exercise. And it's important it all joins up because, for example, there's not a lot of point in undertaking some estate planning within a family to minimise tax exposure whilst trying to keep control within the family. If suddenly we've got LPAs being brought into play where, for want of a better term, outsiders are appointed as attorneys and suddenly are thrown into the mix and able to make decisions. Interestingly, LPAs or powers of attorney in general are actually one of the things that I find are parts of the toolkit that are actually most often overlooked. And I'm not sure whether that's because there's a conception that the next of kin is able to make decisions without any legal standing, or LPAs are just thought of as something that allows people to pay the BT bill, for example. I don't know, but they are the part that's often the most overlooked, and they do play a very intrinsic part in the overall estate planning exercise. So, as I mentioned ago, one of the misconceptions about the LPAs is they're there just to allow the management of day-to-day affairs. Well, that's not, strictly speaking, untrue. In fact, it's very true. It's their primary function. But if the estate planning exercise is done properly and that holistic approach is taken, they can be a very useful tool as part of the exercise and achieving the end goal. For example, say we have Tom and Dick, who are friends. They run a successful business together through a limited company. What happens if Tom loses his capacity? As a shareholder, he has voting rights that need to be exercised, and if he can't exercise those voting rights, who does? There are potentially some resolutions that might not be able to be passed, depending on the numbers of shareholders and the actual resolution itself. An attorney can exercise Tom's voting rights, but who would he want to be his attorney? Who would Dick want to be Tom's attorney, given it's a small, in inverted commas, business? Would it be in the interests of the business for the person with his voting rights to be Harry, Tom's best friend, who isn't very business orientated, doesn't really know how to run a business? What if Tom is married or in a civil partnership? How does that feature? Is there a shareholders agreement? As you can see, there's a lot of elements that fall out of LPAs and the issue of loss of capacity, and those questions need to be answered and looked at in sort of granular detail. But of course, they all start pulling into various other elements within the overall picture. With the next slide, there we go. So there are a couple of points though to bear in mind when thinking about LPAs as part of that overall picture in general. I mentioned Tom and Dick and their business a moment ago. It might not always be possible that an attorney can be appointed. For example, with a company, whilst generally speaking, an attorney can exercise voting rights in respect of shares. Generally speaking, in the absence of anything to the contrary in the company's articles, directors cannot delegate their functions. And of course, it's the directors that deal with the day-to-day running of the business. And so then you have a question there of how does that sit within the wider estate planning piece that's being undertaken, particularly, if you've got something like family companies involved, who is suddenly going to be exercising those decisions, that decision-making process during the day. Your business interests, as I say, we talked about Tom and Dick in that example. And then when it comes to trusts, which are again a thing that is often used very widely within the estate planning exercise, they in particular have a number of complexities there, and there's some specific legislation that needs to be taken into account. I'm not going to touch too much on that at the moment because I will come back to trusts later on. But of course, all of that does beg the question, what happens if there isn't anybody to anybody who has authority to make decisions, to exercise voting rights, etc. You know, at best, depending on circumstances, we could get a deputyship order. At worst, we end up in court trying to resolve the issue. So as you can see, hopefully, you know, it's vitally important that LPAs, or at the very, very least, the potential issue of loss of capacity at some point is considered and included in that estate planning discussion, you know, whatever, wherever that discussion's having, whoever's having it, and for whatever reason. And so really the most important thing about wills and LPAs in this sense is keep them under review. You know, that's very true of life in general, but where we have clients who are undertaking wider estate planning and sometimes some quite complex estate planning, they are unfortunately sometimes the things that do slightly fall by the wayside. You know, I have in the past had clients prepare wills on the basis that ultimately their estates go down the family in a specific way, but then they've gone off and undertaking their own or sort of estate planning or as a discrete task, which has meant that something they've done there has ultimately meant that their end goal, as far as their wills are concerned, you know, the ultimate end goal as far as devolution of estate is concerned, couldn't be achieved. And sometimes that undoing all of that can be very problematic and have adverse consequences elsewhere. I do find that, you know, that more commonly happens where somebody undertakes some tax planning exercises in isolation, and consequently doesn't factor in the bits we've done with wills and the like. And it's there as well that you know, we have the particular complexities of trying to undo things, because of course once the tax event has been triggered, it becomes very difficult to undo it. So as I say, important thing in life in general, but in particular when it comes to estate planning, is keeping wills, LPAs under review at regular intervals, and whenever undertaking any new estate planning exercise for whatever reason, whatever element it is. So having talked a bit about estate planning encompassing tax planning a few times now, I think this is probably a good moment to hand over to David for him to look at those tax planning parts in a bit more detail. So I'll leave you with David.
Thanks, Bruce. Hello, everyone. Welcome from me. I think yeah, Bruce and Catherine and I might be sort of darting back between one another on the various subjects that we've been talking about. We thought perhaps at this moment it'd be worthwhile, you know, touching on some of the, you know, the basic tax principles that you know, that inform the, you know, the estate planning process, and you know, in a number of cases will actually influence some of the behaviour in our lifetime. And you'll see some of the highlights, we can call them highlights, on there now. I think a lot of them will be, you know, known or familiar to some of you, I'm sure. But I think it's probably worth sort of setting a bit of a backdrop in terms of tax and estate planning. You know, the UK's got I would regard a very, very complex tax system, and we find it getting increasingly complicated. And I find it increasingly complex, not simply for those with very large estates or very complex lives, but increasingly complicated for people who perhaps would consider themselves economically not, you know, super remarkable in that context. If you've got an estate worth more than £1 million, certainly above £2 million, then there's certainly a lot to factor in. And I think it's complicated because of the way that the government goes about making its laws. So we don't wipe the slate clean and have a new set of laws every so often. We sort of add these layers on top, and actually over time, once we sort of slice a particular direction through that, you actually find various outcomes, which sometimes in some cases are nicely much more favourable than you might have imagined, and in other cases are far less favourable than you might have hoped for. So I think we have to certainly bear that in mind. I think we also have to have in mind that certainly over the last couple of years, there's been a lot of reports, some from government, some from outside of government, talking about the need for a whole-scale reform of capital taxes, so inheritance tax and capital gains tax. So actually we're finding, you know, in the recent past, we're looking not only at the tax legislation that exists today in terms of what we want to do, but we're also testing it against what the position might be some years from now. I think, you know, we had our autumn statement recently, and there were no changes, you know, made by Rishi Sunak at that point. I think there's a view out there, which is that if you're going to make some big changes to the tax system, you'll do it early on in that electoral cycle. So we've got an election in May of 2024. So obviously this is all complete speculation. But do we have between now and then to look at if we are provided with a lot of reliefs that are available today, do we want to make use of those over the next couple of years in anticipation that they might that in a few years' time we might look back and wish we had some of the reliefs that we have today. But you can see on the slide, those particular highlights, and it's no surprise that actually if you when you die, your estate is subject to inheritance tax. I think it's a relief to a lot of people to know that that transfers on death between your spouse or your civil partner, in most cases are exempt from inheritance tax without any limit. But of course, in the occasion of a second death, assuming the spouse civil partner hasn't remarried, then that's when we're into the potential for inheritance tax. But for a lot of people, we'll have they'll have a nil rate band, an IHT exempt amount of 325,000, and if your estate is under 2 million, then you might qualify for an additional 175,000 if you leave your home to your children or grandchildren. So in a scenario where you've got a couple, then we have up to £1 million of nil rate band where our estate is under 2 million. But of course, the excess above those nil rate bands is liable to inheritance tax at 40%, and 40% is a figure that if people aren't aware of it, certainly their eyes widen when they hear that 40% number 40% given to them. But it's important to note, of course, we've got 0% on some business assets, which is really important. And there's an exemption for things like pension funds and some life policies, and those factors do influence behaviour during your lifetime. So if you've got cash in your bank account or you've got pension savings, you might choose to consume your cash at bank before you consume your pension savings, because one has an inheritance tax-free wrapper and the other doesn't. So some highlights there that to illustrate some of the key things that inform our discussions around estate planning. The other thing to mention, of course, is around capital gains tax. That capital gains tax isn't charged on death because of the fact it's within the inheritance tax regime, but the assets are then rebased. So assets received by, let's say, the next generation, if they were to sell them shortly after, wouldn't generally be subject to capital gains tax because the base cost is the value at death. But just some highlights there. But what I wanted to do is go on and talk about two further specific points that have a significant relevance to a large number of our clients. And the first of that is business assets. So if you have assets that qualify for business relief, then potentially they're subject to 0% inheritance tax, and that doesn't have a limit to its value. So clearly, for those people who have business assets, and give you some ideas of what sort of business assets are on there, whether it's a sole trader or a partnership or your own trading company, that's a very valuable relief. And it may be known to some of you or not that shares on the alternative investment market are considered unlisted for this purposes and considered business assets. And if we've owned business assets for 2 years, then we can hopefully qualify for the 0% rate of IHT. And it does mean that if you don't have any assets that qualify for business relief, does this incredible relief mean that you should acquire some? Or that involves an investment decision? But in some cases, if you're someone who owns business and investment assets, there can be certain benefits to reorganising what you own, and which I think it sort of illustrates some of the you might say absurdity or complexity within the IHT system. If you want to flip on to the next slide, Kieran. And this is just an example here of somebody who has cash at bank, but they might decide that they want to invest half of that into main portfolio shares and half of that in a family company that carries on a trade. And in 2 years' time, actually, we're looking at 0% IHT on the million rather than 40%. So, of course, we've got to get entirely comfortable with the fact that we're making a different investment decision. And I know certainly when we're talking about investing in the son's company and things like that, Catherine will touch on all the excitement that might go around with something like that. So we can't enter these things lightly, but there's certainly reliefs that give us cause to look at different decisions, different investment decisions, I would say. And for those clients who've got business assets and investment assets, just to almost illustrate what I'm saying here about the complexity of the tax system, that if you have business assets and investment assets, you can sometimes combine them and have relief for all of those assets, which you might think, well, that's contrary to logic or contrary to a system that you might put in place if you were writing the rules on inheritance tax. But nevertheless, that's the position that we have. If we have a trading business, or we have a business or shares in a company in this particular example, where the majority of the activity is trading, we have a smaller proportion of that, which is a property business, then potentially all of the shares would qualify for business relief. I think certainly on the next slide, we come to the reverse of that, which is if we have lots of investment activity and trading activity together, we might find that we get a better outcome, because if we have a majority amount of investment activity, that none of it qualifies for business relief, and therefore we might require ourselves to demerge these businesses into two, so at least one of them can qualify for business relief. So business relief, an important thing for us to consider, whether we own businesses or whether it's relief that we want to, or we decide that we want to get into. But again, just some examples there of how the system works in a way that you wouldn't, the layperson necessarily wouldn't expect, I suppose. So again, I want to talk about gifts. So it's probably no surprise that when someone hears the 40% test, the 40% test, the 40% IHT liability, that they feel much more inclined to make a gift during their lifetime. But of course, that then has consequences. The obvious one, which is affordability. I think people are generally living longer. I know that's probably not, it seems absurd when we talk about COVID and the impact, but I think if you're a 65-year-old man today, that your life expectancy is in your 80s, and I think there's a 1 in 4 chance that you might live to 94, according to the Office of National Statistics. So people are living longer, and clearly an impact of that is around affordability. So a gift may be very attractive from a reduction in IHT perspective, but it's not very good from an affordability point of view. It's not very easy to determine in 25 years' time what the cost of long-term care might be. So when we talk about gifts, there's a lot that goes into considering whether that is a good thing to do or not. But certainly on the taxation side, with things like gifts that you wouldn't normally expect there to be stamp duty, land tax or stamp duty. But what you will find is that there's capital gains tax based on the market value. So if the asset here was a property, you'd find that you've got to pay capital gains tax on the market value, based on the market value of that asset within 60 days, despite the fact you might not have any cash from that. So we have to keep the considerations in mind. And of course, affordability for me would come first. But so the attraction of gifts is that after 7 years, it's no longer part of your estate for IHT purposes, and isn't then potentially part of this 40% liability. When we talk about gifts, I think that sometimes people don't imagine two things. One is that you don't have to give the whole thing away; you can give a share in something away, potentially, and that they're also not familiar with the fact that you could actually sell something undervalued. So when we talk about gifts, we can consider gifting part of something, and we can also consider selling something, for its value or for less than its value. So again, keep those sort of things in mind when we're thinking about gifts, and the tax consequences are pretty similar to a gift as far as joint ownership is concerned. And here we have an example of sale. Of course, when we have sale and there is consideration, then we do bring stamp taxes into play. But again, we will always have CGT based on the market value. But certainly when we're looking at control, joint ownership, that gives you some influence. And if we're talking about benefiting from those assets, and we talk about affordability, are you able to sell assets to the family? And it might be that they pay that over time. We had a client who had an investment property that they'd owned on which there wasn't a gain, but they decided that they could afford to do so, but decided to sell the property to their son for £40,000. 40,000 also being the limit below which we wouldn't have to pay any SDLT, but the sons agreed to pay £500 a month until that £40,000 is extinguished. And it turns out serendipitously that ties in very nicely with then the state pension kicks in for this particular client. So again, if you're thinking about gifts, you could think about it, in a round, and think about these other aspects that you might consider. But yeah, I think there's just a whistle-stop tour of some of the basic principles of IHT, and two areas that I think are important to understand when we're looking at these things, which is business assets and sales and gifts and things like that. I think it's possible, Bruce, that you might be looking at the questions of trusts and things like that next. Is that right? If I've got it right, Bruce?
Yeah, you absolutely have. We mentioned, thank you, Dave. We mentioned trusts earlier on. Or I mentioned trusts earlier on as a method by which estate planning is undertaken. And lots of the stuff that David has just touched on will feature within that. And I think David will focus a bit more on tax and trusts in due course. But I thought what would be quite useful to start with is just have a look at trusts and estate planning in general. And probably a good place to start is to quickly cover what a trust is, what a trustee is, what a beneficiary is, as when sitting down and talking to clients about estate planning exercises, these are often the questions that come up early on in that conversation. So essentially, a trust is a structure whereby a trustee looks after assets for a beneficiary. The trustee is the person who is responsible for looking after those assets and dealing with them in accordance with the terms of the trust, i.e. they are trusted to do so. And the beneficiary is a person or persons who ultimately benefit from the trust in one way or another. And depending on the type of trust, there can be a class of beneficiary or specific beneficiaries or charities, various ones there. And I'm often asked, is it possible as part of that planning exercise, and it does feature quite heavily quite often, is it possible for someone to be a trustee and a beneficiary at the same time? And the answer is yes, very much so. They just wear different hats depending on what we are doing at the time. But of course, there are potential issues here, complications that need to be borne in mind, particularly around things like conflicts of interest and so forth. But it is possible. So how does the trust work? Well, as I say, essentially, trustees hold the trust fund on trust for the benefit of those beneficiaries. A trust document, whether that's a specific trust deed itself, a will, or even the operation of law, essentially dictates the terms on which the trustees hold that trust fund and gives them their powers. And those powers can be anything from how the trust fund is distributed to the beneficiaries, or something such as having a power to add additional beneficiaries later on. And again, those powers are something that comes into play or is part of the discussion when looking at setting trusts up. And as the trustees are trusted to look after that trust fund, they've got a number of fiduciary duties and responsibilities. As after all, they are in a position of trust, because essentially the trustees legally own the trust fund, but the beneficiaries beneficially own the trust fund. And that two-layer, so the concept of that two layers of ownership is often an unusual one to sort of get heads around. And I think it can be best demonstrated with this simple diagram that I've got on the next slide. As I say, legally, the trustees own that trust fund. They sit at the top. They sit within the law. They're the legal owners. They're entitled to have their names entered on registers of title of land, registers of registered members in company books, etc. But English law has this concept of equity, which sits underneath the law, and it's the means by which the beneficiaries beneficially own the trust fund, i.e. those assets are beneficially theirs. Equity was developed years ago by the Chancery Courts, and as a result, we ended up with this concept of a person being able to legally own something, but not be the beneficial owner. Hence why we have trusts. So you have the law sitting there and equity sitting underneath. That is a very simple explanation, I should say, of the basics of trusts and equity, and one which certainly doesn't do my university lecturers any credit. So I shall offer an apology to them right now for that. But why do we use trusts in estate planning? So one reason historically has been as part of a tax planning exercise, although significant changes to the tax treatment of trusts back in 2006 and some tweaks in recent years have meant that they have not been as tax advantageous as they perhaps once were. But they still have a place in the tax planning part of the estate planning exercise. But as I said before, David's going to cover that a little bit in due course, so I'll leave the tax elements alone for the time being. But the particularly attractive thing about them as part of that overall estate planning piece is that they can be set up in such a way that the trust fund doesn't belong to the beneficiaries, which means that ultimately, if asset preservation, asset protection for future generations is one of the driving factors, they're very, very useful there. But again, going back to needing that holistic approach, these carry tax consequences, the asset protection is one element of it, the tax is another, and there are other bits and pieces as well. So it's a balancing exercise to say, is the trust the right thing? Because as I say, one of the key things is that control sits with the trustees, subject to the terms of the trust. So one of the things that we find that clients particularly like is, particularly when they are setting the trust up during their lifetime, they can retain an element of control. So they might not be able to benefit from the structure that is put in place, but they ultimately can retain control one way or another. They may be a trustee themselves. They may retain the power to appoint new trustees later on, but that control is often an element that features within the wider estate planning exercise, and trusts come in very useful there. But as I say, it's one element of many that we need to think about when adopting that holistic approach to all of this. So as I say, it's one of many things to think about. And on the next slide, we should have a few more. For example, who are the trustees going to be? What's the purpose of the trust? And does having the persons that the decision being chosen at the moment as decision makers in respect of that trust fit within the wider estate planning picture? Are they suitable? If the trust is being set up to preserve assets from errant beneficiaries, are those trustees people who their character is such that they are willing and able perhaps to stand up to demands from beneficiaries? How many trustees are needed? We all, starting points, we should normally have at least two for various reasons, both legal and practical. But of course, if you end up with one trustee, what's to stop that one trustee choosing their favoured beneficiary, which comes around full circle to the who are we appointing question. Does the person creating the trust see the trust more as a vehicle for operating a business? And if so, how does it fit in with that business? And of course, there's lots of points to think about with the business as well. On the next slide, there's another few more bits and pieces there. How does the settler envisage the trust going forward? How does it envisage operating going forward, and how does this fit in with the circumstances of the beneficiaries and indeed the settler, the person creating the trust? Because often the estate planning piece is not necessarily, although the intention is to plan for future generations, if this is done during a person's lifetime, they are still part of that overall picture, aren't they, and need to be considered. What are their circumstances? What type of trust is best for what we're trying to achieve? And again, this is driven by a number of factors, such as tax consequences, the level of control required, the actual mechanics of the trust. And it all boils down to the ultimate question of how does the trust, or how does creating a trust fit within that wider estate planning? Going back to what I said at the start about wills and LPAs, it's one element within that toolkit of the estate planning, and there's so many bits that it pulls in, perhaps not necessarily conscientiously, but need to be pulled in to make sure we do look at all of it and to achieve that end goal. I like those who have sat through the conversations with clients with me previously, I liken it to a jigsaw, in that we've got a picture on the box we know that we want to make, we just don't know how many parts, who's got those parts, and where those parts fit in. And it's about creating that jigsaw puzzle, if you like, that picture off the box. So as I say, inevitably all of those questions are going to give rise to further questions and further points that need to be discussed to ensure that everything dovetails, particularly as if we don't, this potentially gives rise to further issues down the line, and depending on what happens. And what I've done there is I've put a few points that to think about, or should be thought about, and sometimes are missed. Going back to the capacity point, what happens if one of the trustees loses capacity? The law around this area itself is quite complex, and even more so if there are LPAs floating around in the background. But what we don't want to find is the trust has suddenly found itself hamstrung because we've got a trustee that hasn't got capacity to make a decision, because the starting point is that trustees have to act unanimously. And I actually do have an ongoing matter at the moment where we are going or having to go to court for an order to remove a trustee and replace one as a result of loss of capacity. So again, thinking about that, planning for that as you're going along. What happens on the death of a trustee? If this leaves one trustee, is the settlor, the person creating the trust, happy with that one person having essentially control to make decisions on their own? Who has the ability or the power to appoint new trustees? Does the settlor want consultation in the event of distribution? There's bits of ways in which we can deal with that as part of the wider picture. But again, there's implications depending upon what the wishes are. And ultimately, what happens if the circumstances of a beneficiary change, or that beneficiary receives funds from other structures that have been set up as part of the estate planning exercise? And it goes back to my point earlier about putting a will in place where an estate goes to X and Y, for example, because X, the testator wants X and Y to be treated equally, but suddenly X has had quite a lot of money from a family investment company that's been set up. Well, the scales have been tipped slightly there, haven't they? So again, it's about making sure that the wider picture is looked at and everybody's talking. Which, as I say, the last bullet point on there is definitely the most important. Looking at how trusts work alongside the other structures and just keeping it all as working together to create that picture on that box for the jigsaw. So having sort of galloped through trusts and a couple of bits to think about at quite a pace there, I'm now going to sort of take a seat again and hand back to David, who's going to look a bit more on the tax aspects of trusts.
Thanks, Bruce. Yeah, I mean, something I mentioned earlier on about complexity in the tax system, and trust taxation is, up there in terms of areas where it's potentially very, very complicated, because trusts exist, in some cases for a very long time, and of course the tax legislation will change, over time, and certainly when they've changed the rules on trusts, in a lot of cases what they've done is they've changed the rules for new trusts, not for old. So if we pick up a trustee today, or we have a new trust client that comes to us with an existing trust, we actually have to sort of delve through all of the history books and all the textbooks to work out what particular regime is this trust working under at the moment from a taxation point of view. And it's not very obvious. We know a lot about what happens with new trusts because we've got the current set of rules. But if you have any existing trust arrangements, it's really important to make sure that you understand fully that its taxation status on what you can do, can't do, and the implications of some of those actions. I think we'd certainly be here for hours and hours going through the history of the taxation of trusts, but I think I'm not sure that would that was best use of our time. But for existing trusts, I think it's important to firstly make sure we understand fully everything about that trust and what the current taxing regime is. I think as far as new trusts are concerned, I think it's much better and much more widely understood the various tax consequences. Again, there are I suppose you might say there's an infinite number of types of trusts in the way that they can be calibrated. But I think certainly in my experience from, let's say, a tax planner's point of view, that, the most common new trusts that are being established as part of our estate planning exercise are, a family discretionary trust formed during your lifetime, or a trust that's formed in the will to ensure that assets may be used by a particular spouse, but then need to then be passed on to another set of people, perhaps the children. So those are the most common sort of trusts that I'm seeing in the work that I'm doing. And I thought perhaps it's worthwhile just giving a bit more information about the taxation of what I might call your vanilla family discretionary trust if it's new and establishing it today. I suppose there are a lot of reasons why I think that is a very, very popular form of trust to establish, and I think Bruce has talked around benefits of protection. So we can, from an IHT planning point of view, we can move assets out of your estate, but you can still retain control over it. So that's clearly attractive in a lot of different situations. If we transfer more than £325,000 to a trust, then we have a lifetime inheritance tax liability at 20%. So perhaps it's no surprise that we see a lot of trusts formed either with 325,000 or less, or, you know, if a couple are contributing assets to a family trust, that those assets are £650,000 or less. So that's the value of assets that we can put into a trust every 7 years without there being a lifetime inheritance tax liability. So perhaps it's no surprise then that given those benefits and given those particular you know, lifetime tax costs, that by far the most common form of trust that we see from a tax planning point of view is very commonly a husband and wife transferring £650,000 worth of assets to a discretionary trust in which they are the trustees, but in which, you know, the beneficiaries are perhaps children or grandchildren. But in order to benefit from that particular set of tax rules, the settlor and their spouse and any minor children, if they have them, must be excluded. So that's a really, really important point when it comes to things like affordability. If we're putting assets into that sort of trust, then we can't benefit from the income and the capital of those assets. So it's very attractive in some instances, but from an affordability point of view, it wouldn't be suitable if we need to continue to benefit from those assets. So very often these trusts are established by people who feel comfortable that they won't have a need to benefit from that level of assets going forward. I think the other attraction of moving into the trust, because it's an occasion when OHT is payable, even if it's a nil, that you can claim something called holdover relief for that sort of trust, i.e. there is no CGT liability in the way that there is if you were just to give the assets away. So perhaps it's no surprise, as I said, that is a very, very popular set of arrangements for a lot of clients. What we should say is that the trust has its own taxing regime. So in particular, in relation to inheritance tax, that this sort of trust would be paying inheritance tax every 10 years. And that would be at a rate that is no greater than 6%. And it would certainly be, IHT would be payable if there are any exits of capital from the trust after that 10-year anniversary. But of course, if a generation were thought to be 30 years, that 6, 12 and 18, you find yourself in a lower taxing regime per generation than you would if it was passing individual to individual, but, you know, with the protection of those beneficiaries, because those assets, you know, do not form part of their estate for their own taxation or other purposes. Something that we find works particularly well is a discretionary trust with that level of assets settled by granddad and grandmum, where the income generated is paid out to the minor beneficiaries, because the income is ultimately taxed on them, particularly children. So you can have a very efficient IHT regime and an income tax regime, you know, where the circumstances permit. As I say, lots of different types of trust arrangements, but you know, I think I'd probably say that 95% of the trusts that we get involved in and advise upon nowadays look something like that. There's lots of older trusts that have very different regimes, but new trusts often have that sort of characteristic, I think. So it's worthwhile just going through that. We then move on to something else. We've talked a bit about the principles of IHT, talked about gifts and selling and the use of trusts. And there's a fairly sort of rudimentary table there, which sort of has a sort of a yes/no assessment of whether it's good or bad for particular scenarios. And I think, you know, for the reasons that Bruce has said, you know, that is far too rudimentary to be applied across the board. We've got to look at these things, you know, in your individual circumstances. But I think the point that the table does make is that various different actions have certain positive and negative characteristics to them. And actually all of these different actions, you know, have a different profile in terms of your ability to control what's happening, to benefit economically, whether they do or not protect the family, and also whether they're considered to be income tax IHT or even income tax efficient. And in a lot of cases, you know, we find that you can get to where you need to be from an estate planning point of view, from a tax planning point of view as part of that, by making use of making the right investments, or making use of trusts. But there are some instances in which it really doesn't go far enough for some clients, and they're saying, well, what else have we got? And actually, I'd like to have a profile of outcomes which is going blue across the board in terms of control and benefit, family protections. The answer is that there isn't something that ticks all of those boxes 100%. And so it's always about making some form of compromise. But what we have found is that there are arrangements involving family companies and family partnerships that, you know, can achieve close to, you know, the best sort of outcomes that you can get realistically for all of those particular characteristics. But it's true to say that they're complicated, and I know Catherine will talk in a minute, about some of those complexities, and of course the important need to get, the documentation and the arrangements, fully understood and documented by all of those that are involved. But there are a very, very wide range of options for customization. But of course, we are essentially going into business with our family members, with the people that ultimately we want to pass those assets to. And being in business with your family, might cause you to shriek and run for the hills in some cases, and in other cases, you might feel entirely comfortable with something like that. So it's not for everyone, but it's certainly something we're seeing a lot more of as people try to, really satisfy as many of those criteria as they can. And I've got a couple of examples. Again, as far as calibration is concerned, there's lots of different variable ways of dealing with these things. But in this particular simple example, an owner of investments sells those investments to their family partnership. In this case, it's a limited liability partnership in return for a debt. And the economics here is that the investments are earned by the partnership and potentially then taxed on the partners. But rather than them withdrawing those funds, they use it to pay off the debt. And so in that instance, you can find that if you're the owner, you have your estate is fixed at the value of your debt, but as you're distributing, that repaying that debt over time, so the value of your estate diminishes. But as a member of the LLP in this example, potentially as a trustee of the family trust as well, that you clearly have some significant influence on how the business activities of that LLP are carried on. Now, it isn't true to say that we can dictate 100% what happens to that. We are in business, in this example, we are in a partnership, a limited liability partnership with other family members. We can't compel them to be members, I don't think. Catherine, correct me if I'm wrong, but I don't think we can compel them to be members in a partnership. And we can't ask them to remain there. They can resign and leave in that scenario. So we can't have 100% control over what happens. People have to have the freedom to come and go. And of course, if we did have an arrangement where, in effect, the economics of the position was that you had 100% control over everything that happened, in fact, that would actually undermine the tax efficiency of what we're talking about, because you can look through all of that, say. So again, something that is relevant to consider in some cases. And here's something similar with a company. Whether we want a partnership or a company will come down to a lot of other issues. But in this particular example, you're a shareholder with a company. And the company might hold investments. But because we have a company that has articles of association, that you can have share rights that can be customized, that you can arrange the shares of the company such that, for example, the growth in the value of the company accrues to the family or the family trust, whereas you retain, perhaps more of a fixed interest in all of that. So you can, try to have your cake and eat it as much as possible in terms of the control and the benefit. But ultimately, there's always an element of sacrifice that goes into that. And ultimately, we are in business with our family, and that carries risks. And various clients that we talk to will actually say, I feel entirely comfortable with that kind of arrangement, and others will feel the direct opposite of doing that. But in appropriate situations, these sorts of arrangements, we think, can satisfy a lot of those criteria. And actually, there's some, very favourable tax outcomes as well that you can end up with. Yeah. So I don't know if we've got a next slide, Kira. Yeah. So sorry, I think passing over to Catherine now to talk about I guess the things that then follow on from all of that.
Thank you very much, David. And in answer to your question, no, in normal circumstances, you can't really compel people to become members or shareholders. Hello, everyone. I'm conscious we're a little bit tight for time now, so what I'll try and do is give you about another 10 minutes or so, and then we might have time for a couple of questions. Maybe we'll run over if you're comfortable to do so, but obviously if you need to go off into your day jobs, then we'll let you have the video and answer any questions by email if we don't have time for those. So what I'm going to do is give you a quick overview of some of the differences between limited companies and limited liability partnerships, talking about the sort of structures that David was just talking about now that you might want to think about for your investment structure. I think one of the important things to say at the outset is that there are a lot of different legal forms out there to choose from. So those include, for example, general partnerships, which is perhaps the more old-fashioned form of partnership. So that's where there are two or more people working together with a view to making profit. Just because it's a little bit old-fashioned doesn't mean that it's not alive and kicking. Obviously, there are some very successful partnerships out there still and will continue to be so for some time. There are limited partnerships, which is quite a niche beast. There are many, many different sorts of company available. But for today's purposes, I'm just going to look at limited liability partnerships and companies limited by shares, both of which David's already touched on. Next slide, please, Kira. Without wishing to encroach on David and his area of expertise, I think it is worth looking at some of the things that make a limited liability partnership what it is. And one of those elements is that it is tax transparent. That means that each member is taxed on their share of the profits. The LLP itself, the limited liability partnership itself, is not taxed. And if you are setting up a limited liability partnership and you're a member of it, you need to be a little bit careful for tax purposes about the distinction between a member and a salaried member. So if you are taking, for example, a regular monthly income consistently that isn't tied to the profits of the business, you need to be very careful because there's a good chance you're going to be taxed as an employee rather than as a member of the LLP. So that's just something to think about. Next slide. Yeah. A quick overview of limited liability partnerships. The structure was created in 2000 by the Limited Liability Partnerships Act. It was then, still is now, very popular, in particular with professional services firms. So we are Ricks and Case listed as LLP, for example. In terms of terminology, you're not partners. The people who take part in a limited liability partnership are members of that limited liability partnership. They're not partners technically as understood by partnership law. A limited liability partnership is a separate legal entity from its members. It's liable for its own debts and can own its own assets. It can contract in its own name. It can sue and be sued. It does have to have at least 2 members, and it does have to have at least 2 designated members. The designated members are the people who bear the ultimate responsibility really for the LLP, and they are notified as such to Companies House. However, a limited liability partnership won't fail for just having 1 member, and we'll look at that in a little bit more, a little bit later. An LLP has this, sorry, Kira, may I? And so an LLP's got the security of limited liability for its members, but it's also got the flexibility of a partnership arrangement. The other thing to bear in mind about it, differently from partnerships, is that it does have accounting and filing obligations very similar to those of limited companies. So you do have to file your accounts every year at Companies House, and you do have to make certain event-driven filings, for example. So if you change your designated members, that has to be notified to Companies House. Thank you. In terms of the members and their own liability, which is obviously a key point, the liability is limited, and it is limited to the amount of those members' own contribution to the LLP. There are, of course, exceptions. There are always exceptions. And those are generally, if a member contracts in his or her own name rather than in the name of the LLP, they can find themselves personally liable. If the member is negligent, they could be personally liable. If the members agree amongst themselves that in certain circumstances they have to contribute more into the LLP, then of course you're going to be contributing more under that agreement. And the next one, this is where being that sole member comes back into play, because if for any reason you find yourself as a sole member of a limited liability partnership for more than 6 months, at the end of that 6-month period, you will find yourself jointly and severally liable for the obligations of the LLP. Thanks, Kara. Looking now at the sort of documents you might want to put in place for an LLP, the question is, of course, should you be looking at having a members agreement, so an agreement in place between the members of that limited liability partnership? And I think our position on this is generally we would say, yes, it's a good idea. The reason for that is because in the absence of a bespoke agreement between the members as to how the LLP is run and how they operate as between themselves, the default provisions of the Limited Liability Partnerships Regulations of 2001 will apply. I'll look at those in a little while. A members agreement is your chance to determine the rules of the LLP. You can say how it runs, you can say who does what and how they do it. You can look in the agreement at such things as place of business, ownership of property and intellectual property, who are your bankers, who are your accountants and auditors. Critically, how are you going to distribute the profits and losses of the LLP? Again, looking at that issue that we just discussed, are there going to be further contributions required into the LLP and in what circumstance? How are you going to take your drawings? What are you going to do about new members? What are you going to do perhaps about expelling non-performing members? You can look at the management of the LLP, what happens on retirement of death or members, for example, whether you want to put in place restrictive covenants, so non-compete provisions in relation to the members. All of those things can be taken into account in a bespoke agreement. May I have the next slide, please, Kira? If you do not have a bespoke agreement in place, then you are subject to the regulations contained in Regulation 7 of the 2001 regulations. I'm not really going to look at any of those in detail, but I think the two that I would like you to take away with you particularly is that if you don't decide for yourselves what happens in your LLP, then it means that the profit share for members is always equal, which includes obviously loss share as well. And all members are entitled to take part in the management of the LLP. You might not want that to happen. You might want, for example, to have the management resting in a few people, similarly to how you would have in a board of directors in a company. So those are the particular ones that I think it's worth thinking about. There are those provisions in place, so it's not as though you are ruleless if you choose not to put a members agreement in place, but the rules might not be quite crafted how you want them to be. Next slide. Okay, so having a little look now at companies limited by shares, and again, just touching on the taxation side of things very briefly. In contrast to LLPs, companies limited by shares are tax opaque. That means that the company is taxed as a separate legal entity. Its directors and employees are taxed as directors and employees, and the members tend to be taxed on the profit that they get out of the company, which come out generally by way of dividend. Next slide, please. Quick overview of companies limited by shares. There isn't a maximum number of shareholders. You can have a single member company, so there isn't really a minimum number of shareholders either. In companies limited by shares, in terms of terminology, you can talk about shareholders, but you can equally talk about members. That's all understood. Again, one of the critical elements of companies limited by shares, as you would expect, is that the liability of the members is limited. That liability is limited to the amount remaining unpaid on a member's shares. So, for example, if I subscribe for 100 shares of £1 each, and I only pay up £50 now, then at some point in the future, I remain liable to pay that additional £50. If I pay the £400 now, that should be the end of it for my liability in terms of the company, unless, of course, I agree to subscribe for new shares. One thing that you might remember from previous webinars that's worth bearing in mind in terms of companies is that there is a separation between management and ownership. So the management of a company rests with the directors on a day-to-day basis, whereas the ownership is with the shareholders. In small companies, particularly in family-owned companies, as what we're talking about today, there's a very good chance that those two roles are undertaken by the same human beings. So you might be simultaneously director and shareholder, but it's worth bearing in mind that you do wear two different legal hats and you do have different legal functions and obligations as a consequence. Documents to put in place for a company. Differently from LLPs, you must have articles of association in place for a limited company. They are a publicly filed document, and what the articles of association are is essentially the rules of the company. They determine how the company is run, what the directors can do, some of the things the shareholders can do. They're the rules of the company. You can have bespoke articles, or you can have Companies Act articles called the model articles. There are also other Companies House filing obligations in relation to limited companies, such as event-driven filings. Again, if you change your directors or if you change your registered office, that always has to be notified to Companies House. And you've got your annual filing obligations, like filing your accounts every year and filing your confirmation statement every year. Thank you. So again, a similar question to what arose with LLPs. Is it worth, in addition to the Articles of Association, having a separate agreement between the members of the limited company, so a shareholders agreement? Here, I think the answer is a little bit different. It's not always necessary, I think we would suggest. A well-crafted set of Articles of Association might get you to where you want to be in terms of setting out the rules that you want in place for the company. Against that, as I've mentioned, the Articles of Association are publicly filed, and you might prefer that you have some provisions that aren't available to view to anyone who's got access to Companies House. A shareholders agreement can be a private document. You can keep it to yourselves. It doesn't have to bind every member of the company in the same way as the Articles of Association do. It can bind only those parties to it if you want. It can deal with, again, very similar issues to the sorts of things that you might be looking at in an LLP agreement if you're putting in place an LLP, and that's, for example, how the company is run, so looking at management and directors, maybe who has the opportunity to appoint directors, what happens if people want to transfer their shares, what happens if the company wants to issue new shares, do the existing shareholders have rights of preemption on that new issue? Are there any matters that you don't want the directors to be able to run by themselves? And therefore, do you want them to have to come and ask the shareholders about certain things? Do the shareholders have those rights of veto in some circumstances? You might want to think about putting your dividend policy in a shareholders agreement. Again, thinking about restrictive covenants. Do you want to stop the shareholders from competing with the business of the company during the time that they're shareholders, and maybe after the time that they're shareholders as well? And of course, it's always worth looking at deadlock procedures, because as David mentioned, occasionally in family businesses, there are times when you don't all agree. And deadlock is when the shareholders simply cannot agree on a course of action. So sometimes it's worth having provisions in your shareholders agreement dealing with that situation. Next slide, please, Kira. Okay, so again, that was a very quick run through of just some of the things to think about when you're looking at the corporate structure that you might want to put in place if you're looking at family investment businesses. There are a lot of options available to you. And what I would encourage you to do most of all is to have a think very carefully about what you're trying to achieve when you're deciding on the corporate structure that might suit you best, because it might not necessarily be the structure you think of first. Once you've decided on your structure, have a think about whether a members agreement suits or whether a shareholders agreement suits, depending obviously on what structure you choose, whether that might assist you to actually achieve the goals that you're looking to achieve. Next slide, please, Kira. And that brings us to the end of the presentation part of today's webinar. I'm not quite sure where we are on timing, so we've gone over, my apologies. I hope what we've given you is an overview of some of the options that are available to you when you're looking at estate and succession planning. I think it's important that we should note that it hasn't been exhaustive. There are an awful lot of details that we could only just touch on today. And I think the key point that we'd really like you to take away from today is that please liaise with your accountants, your tax advisor, and your solicitors early on in the process when you're thinking about your succession and estate planning, because together as a team, we can guide you as to which options might work best for you. Thanks very much for listening, and I do apologise for taking you a few minutes over. Scott?
Thanks, everybody. Thanks for all the speakers and the session, which was really enjoyable. I hope everyone found that valuable and useful. As Catherine said, we have got a few minutes over, so I'm going to just quickly pick up on a couple of questions, and the other questions that have come through, we will come back to you, like I said. I think one of the questions I'm going to start with was probably picked up on one of David's slides. It was around which business assets specifically has a 0% IHT consideration. I think you did cover that, David. Was there anything else you wanted to add very quickly?
No, I mean, perhaps you cover that perhaps in as much detail as we might have done, but yeah, certainly if you're running a sole trader business, if you're running a trading partnership, an accountancy practice, solicitor's practice, you're interested in that, you could expect that in a lot of cases to qualify. If you have shares in a limited company or an interest in an LLP, it's about the activities that are being carried on, and it needs to be a trade, not an investment activity. So really, any form of trading activity will qualify for all of that. But in particular, the common things that you find areas of uncertainty are around, particularly businesses that have property assets. So we'll certainly have clients from time to time who have lots of property assets and think they're carrying on a trading activity, and in some ways, they are certainly carrying on a lot of doing a lot of work that is akin to trading activity, but it would probably be regarded as property investment. And but yeah, that's probably the area of you might say most debate or dispute from time to time is where investment activities are investment activities, I suppose, that aren't really trading activities like property investment. Great,
thank you very much. I hope that answers the question. Just following on from that, this might be one for David and possibly Bruce as well. Is capital gains tax payable on a gift?
Yes, yeah. So it's subject to capital gains tax. Sorry, Bruce. Yeah, he's itching to go there. He's unmuted himself not quickly enough. But yes, it's payable on a gift at market value. Obviously, the capital gains tax liability is based on the market value less what you paid for it. So if there's tax payable, you've got to work out what your gain is. The exception, of course, is if you're giving it to a trust, that you might be able to hold over that capital gain. I suppose in relation to things like gifting business assets, there are specific gift relief claims that you can make for gifting business assets. So yeah, maybe the answer is it depends, but generally speaking, you've got to worry about CGT when you're gifting.
Great, thank you, David. I'm going to take one more, and the other questions that have been raised, we will come back to you directly, particularly Louise Everest and Ralph Beard's question that look quite specific. So we will come back to you on those. I'll pass the questions over to the relevant speakers, and we'll come back to you by email or we'll pick up the phone. But I just wanted to pick up on one final one, which is it looks like quite a biggie. I don't know whether we'll be able to pick this up, but it's regarding social care with the advent of the 85k cap on privately funded social care starting in November 2023. How might gifts be calculated without coming under deprivation of assets, the asset rules? Is that one for you, David, as well?
Potentially, I suppose. Yeah, I mean, certainly, if we intentionally deprive ourselves of assets, then I think that's probably and then seek to benefit from government support. Then I think that's going to be contrary to the government policy on these things. As it stands at the moment, we actually see a real mixed bag. I think sometimes you hear the phrase postcode lottery used in other areas, but certainly we've seen situations where somebody has transferred an asset to a trust that they benefit from, and the local authority has been made aware of that, but hasn't regarded that as being them depriving themselves of assets for this purpose, which of course is a surprise to me, but is a welcome surprise to her in that scenario. So I think, we just have to exercise extreme care, I think, in that particular area. But certainly, if we intentionally deprive ourselves of assets, then I think that's going to be contrary to the government policy on that.
Great, thank you, David. Was there anything you wanted to add quickly onto that, Bruce? Anything to add or not?
No, not really. Just what David says is absolutely right. I mean, whether or not given the the proposed changes and the sort of the greater benefit, should we say, that are perceived to come out of that and why they were made, it will be. I think it will be interesting to sit down and see if approaches to deprivation of assets change at all. I will admit it's not actually a question that I had given a lot of thought to prior to now, but it is an interesting point, because if you take that sort of analogy and apply it against the various tax regimes where it's often give with one hand and take with the other. Perhaps that's a bit of a strong way of phrasing it, but I wouldn't be surprised if there is another look at what is considered deliberate deprivation and perhaps some different views and changes come out there. What they are, I don't know, but I think it's certainly a question to think about. It's a very interesting one.
Okay, great. Thank you, Bruce. Okay, like I said, we'll pick up the other questions. We'll come straight back to you. So thank you very much. We hope you found that enjoyable. The speakers' details are on the screen there. So like I said at the start, please don't hesitate to drop them a line or an email. If you want to speak to them directly, they'll be happy to take your calls and questions. The recording will come round, so you'll get that very soon if you want to re-watch it. So that just leaves me to say thanks very much for joining us, and have a pleasant afternoon. Thank you very much.